Good day, everyone, and welcome to another episode of Fryer Financial's Financial Forum. I am Marcus Fryer, certified financial planner with Fryer Financial. I am usually joined by Jeffrey Campbell, but today we're having a few technical difficulties. I think it could be weather related. We haven't been able to patch Jeff in yet today, but I know he is safe and sound at home. Um, as we were calling from North Carolina in some very cold temperatures and expecting another winter storm this weekend. So good old North Carolina. At any rate, we will have our three segments today: markets in motion, finance in focus, as well as our wealth wisdom corner this week, talking about separately managed accounts versus model portfolios. And without further ado, let's get started. So this week, markets were a little turbulent. We had some early week volatility. That was driven by the surprise tariff threats, and of course the conversation about Greenland and the United States acquiring Greenland. So that shook the markets up. I think trying to figure out how we're going to pay for that with all the debt we already have is a major concern. Not only here in the United States, a lot of governments across globally are dealing with debt issues. So something for us to think about. With that said, the NASDAQ and S&P 500 were down about 2% during the week. We had a little bit of a rebound. Midweek, we had some stronger GDP data as well as the jobless claims came in a little softer than we expected. So that was good news. But despite all that, we still finished a little lower for the week. Some brighter news: small caps actually stole the spotlight. The Russell 2000 has outperformed the S&P 500 for 14 straight weeks. So that's good news. And let's say as we think about our tail risk and some of the things, again, that tail risk trying to cut off that left side of the tail, as we talk about a lot. Two biggest things that people are concerned about are our geopolitical conflict that led at 28%. Right behind that was the potential of an AI bubble is a concern that many investors are having, and that came in at 27%. So despite our bullish backdrop and everyone kind of excited about how the market is doing, we still, that tail risk management is still key. Finance in focus, safe havens. People are running to gold. Gold vaulted past $5,000. Part of it on the geopolitical stuff, weakened dollar. Part of it because of shutdown fears. So we'll see. So investors are rotating defensively as a lot of this rhetoric kind of heats up. Investor sentiment, a lot of people are looking towards the global expansion that's taking place. So we've even increased our portfolios a little bit with a little bit of investment globally, as well as I mentioned in the earlier, the small cap sector. We've kind of jumped in there a little bit as well. Cash levels are low. They have fallen to 3.2%. That's the lowest level since July of 2021. Also, portfolio protection has weakened. It's the weakest it's been since 2018. So investors are really feeling good about this market. They're shedding their hedge strategies, things of that nature. People are getting off the sidelines, going all in. So although this optimism is quite high and risk management is thinning, again, you still have to protect for that large drawdown risk. We cannot stress that enough. That large drawdown will wreck performance very quickly. So we got a pivotal week on deck. We got the Fed's rate decision coming on Wednesday. We've got earnings from 4 of the Magnificent 7. And we've got a heavy slate of just heavyweight market movers reporting this week. So let's see. Tuesday, we've got United Health Group along with Boeing and Texas Instruments. Wednesday, Microsoft, Meta, Tesla, IBM, AT&T, Starbucks, and ADP. Thursday, Apple, Visa, MasterCard, Caterpillar, Honeywell, Lockheed Martin, Comcast. And finally on Friday, Exxon, Chevron, American Express, and Verizon are all reporting. So we have potential for a lot of movement based on these earnings reports. And finally, again, don't forget there is potential for a partial shutdown again looms as we battle over. Now the battle is over not only Obamacare subsidies, but Homeland Security funding. So the fight continues on Capitol Hill. Let's watch how that plays out. Today's Wealth Wisdom Corner. One of my favorite things to talk about: separately managed accounts versus model portfolios. So let's kind of begin the conversation with model portfolios. Um, so model portfolios are developed by us as advisors, and they are kind of designed to be very efficient, scalable, and kind of good for broad goals. Right? We're more so looking at clients by their risk tolerance, but not necessarily by their risk capacity. And so what happens from that standpoint, and what I mean by scalable, is scalable from an advisor's practice standpoint. But my question is that really the best for the client? So I can have 10, 20, 30 clients all with a moderate aggressive risk tolerance, but they're all trying to do different things. So why would I have them all in the same portfolio? So it just doesn't make sense to me. So that's why we're of the position that everyone should have a separately managed account, because we're trying to manage towards your risk tolerance, towards your tax strategy, towards your goals, towards the legacy you want to leave. And everybody's going to a different place. So what you'll hear is that and I'm going to read it. SMAs are best fit for high net worth investors seeking control, personalization, and advanced risk management. So I only actually agree with the last part of that statement. I would replace high net worth investors with all investors. We can effectively implement a separately managed account with as little as $50,000. Our strategies can be effective. It doesn't take a lot of cash in order to implement a separately managed account. It's more so the advisor doesn't want to put the time in to managing the separately managed account. But that's what we're getting compensated for. Otherwise, just ride the index fund like we talked about, because a model portfolio, if it's not being actively managed, isn't much more effective than an index fund if you're not putting the guardrails around it, if you're not putting the risk management around it. And that's the whole point. The SMAs are there to provide what we call precise risk management, whereas model portfolios provide scalable risk management. And the risk management is just putting you in what your profile says so that we're compliant. But we take it a step further and look at not only that, but your risk capacity, your goals, what you're trying to do. So with that said, SMAs are the way to go as far as we're concerned. And all of our clients are in SMAs, and we communicate with them. We call them and say, "Hey, we see this going on in the markets." Again, we talked about it last week with the tariffs. We could see that back in November because we'd already heard the conversation, and we put the hedges in place well before inauguration. And again, our clients were only down 1%, whereas most people were down 10. So now we're starting back down one. Again, last week we illustrated a $250,000 portfolio where our client was down to 245, but anybody in that SPY index fund was down to 188. Where would you rather start your climb back, from 188 or 245? Pretty easy decision if you ask me. And that's why I am not going to change from demanding that we use separately managed accounts in our practice. All right. So that concludes this episode of Friar Financial's Financial Forum. Again, thank you all for joining us. We are looking for ideas for our next for topics for us to talk about, any guest speakers that you guys would like to see. So please share that with us. Email myself, mfryer@friarfinancial.com. Email Jeff, J. Campbell, Campbell, at friarfinancial.com. And until then, we look forward to talking to you. Take care. Bye-bye.